Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is February 1st, 2018, and I'm going to be talking about a lot of different markets here today, really to give an overview of a couple of things. I'm actually working on a workshop that's going to be talking about all of the different things we have in the Deep Dive. But for our purposes tonight, I'm going to show a number of things actually on our pattern side. And what I want to do is I want to focus not necessarily on a market per se, but I want to work and really focus on the stretch, which is a reversal indicator, and the pulse. The main one I'm just going to talk about is the stretch. And I just want people to understand this because I get a lot of questions about this because there's a lot of information obviously on this this deep dive. But the one that is going to be one of the more important is going to be the stretch. Think of that as the primary indicator that you're going to be looking at as far as an alert. And if you get a pulse, you get a even stronger stretch. Just think in those terms. So if we get a stretch, we have a high stretch here in Australian dollar, and it's got a pulse high as well, both of which occurred today. So if we flip right to the market, here's Australian dollar. These are daily bars. And what I want you to start getting used to are some of these different icons and the color of the icons. So we'll just take it step by step, and we're not going to overwhelm tonight and not make this a full-fledged webinar. But when you get this pinkish ball circle, that's the stretch high that has occurred here. And typically what you're going to find is that as the market has this crescendo effect, you're going to start to get a number of different conditions. Lots of different types of alerts are going to pop up, and then the market starts to roll over. And slow as it is, the stretch high is the one that traditionally tells you that it's over and the market's going to tank, and that that's what we're really looking for. Now, we'd like to say in every single instance that as soon as you get this thing, this stretch high, the market's really going to start to tank and really start to sell off. Sometimes it just simply meanders sideways, almost as if nothing ever happened, and then the market starts to rally again. But that's under really, really strong conditions. Hence the reason that I say that when you get the other indicator, the one that's the pulse, in that particular case, when we get that kind of an instance, that typically it's a little bit stronger. So I'm going to show a couple things here. So here is the Australian dollar in the background because it does take a while for this stuff to go through its process. I'm going to start pulling up the Russell here. I'll flip back here and simply show that the Russell 4 days ago, 4 trading days ago, we actually had a stretch high. There was no pulse that went alongside of it, but you'll still see that the market has had some weakness, and that this is actually not a bad indicator here. So here's the pulse high that occurred here in the Russell. I'm sorry, not the pulse, but the stretch high. And then the market has started to sell off. I'll go ahead and pull up the next market here, the S&P 500. Flip back again to the site, and you'll see as of a couple of days ago, 1 trading day ago, we actually had a stretch and a pulse. Now the S&P in particular, more so than the Russell, we've had an instance where the market has just been exceptionally strong, more so than what you see in the Russell. And so when you take a look at that particular market, I'm going to show you a couple of instances. It's hard to see it, but it's underneath this this cross here. There's a couple of things going on for that particular day, but you can see that the market did sell off. Then we had the stretch, and what I want to show in other instances is that here's another example, this stretch high, and the market really had that really nice rally. We finally got the stretch high, and then the market just kind of meandered sideways before having another rally. Here's another instance where the market basically had 1 day and then started to rally. So it is not a perfect indicator as far as an alert, but typically when you get that kind of a condition, not in a super strong market, that short of a super strong market, actually it works out pretty nicely. So we'll take a look at another market here, RBOB. So let me just pull that one up here. And while that's calculating in the background, you'll see that we had a number of indicators. That's the other thing I want to point out. Here in the S&P 500, we've had a number of indicators that have all popped up here. There's 4 of them that have popped up, and that's typically a good sign that the market is truly at some form of a crescendo, and that there's reason to be concerned. And that crescendo could just be nothing, and the market goes sideways. But in normal conditions, something short of a super strong trend, it really does mean something. So with RBOB, it doesn't have the pulse that has gone along with this, but we do have a surge high from 3 trading days ago. We had a days that happened 4 days ago, and then the high happened just yesterday. So you can see that when we had that instance, the other kind of weirdish scenario here is that the market actually rallied up on the day that we actually had the surge high. That's not uncommon, but it can happen, and we would expect the market to start to taper off. Here's a day in which the market sold off. We had the crescendo effect, and it was slow. We did have other indicators that did pop up, just as we had some other alerts that popped up here just prior to the stretch high. That in this particular case, the market did sell off, meandered sideways, and sometimes you'll have an event where there'll still be a secondary rally and then it sells off. Here's another case where it went sideways, but truly in most cases when we do get these types of conditions, the market has a tendency to really want to sell off. So the fact that it's gone sideways, or it had and this would have probably been some type of a bearish divergence, that it may be slow going, but normally we do expect the market to sell off here. Let me just take a look here and see what the next market is, and I'm pointing these out because we had a lot of them that actually triggered today. So natural gas is another market that we'll go ahead and pull up, and we'll take a look at it, and then we'll let that sort of calculate. In this case, we had a high on the stretch and a pulse. Now these just occurred today. There's nothing else on the horizon that recently happened, but nonetheless we are looking at that type of condition. The other thing I'll point out just before I leave here is that sometimes we'll get a pulse without the stretch, and it just simply means that the stretch is the more important of the two, but there was no follow-up, at least on the stretch. But sometimes we'll get the standalone when it comes to the pulse. The final one we'll look at, just to set the stage here, then this is a low as opposed to all the ones that we're looking at here as a high. So let's see what natural gas is doing. And in this particular case, we had the kind of a major sell-off, a pretty major sell-off considering where the highs were. We had some other events that did take place, so I would call this kind of a slow indicator. In this case, normally you'd like to see it really start to show its alert before this, but the market has been just so volatile to the upside, so strong to the upside, that it's not uncommon that it just takes a little while for that particular indicator to pop up. But this is the last of the indicators, meaning that this is kind of like the on-off switch in comparison to a lot of the other indicators, that it does take a while for the market to switch off, meaning it's going to sell off, versus other instances where here the orange is the stretch low. So pink for the high side, think in terms of red, hot numbers, things of that nature, and then yellowish is and oranges as the bottom phase. So in this particular case, we did have in natural gas what we would have thought was a crescendo type effect, where the market had the stretch low. Of course, then the very next day it goes down, but it was close to finding the bottom, and this is close to finding the high, and we'll like to see as to whether or not the market is able to really sell off. The last marker that I'll show here is sugar, and it does take a little while for the calculations here, so just bear in mind that this is a low. All the other ones we've been looking at have been on the high side. And we have with sugar something that happened 4 trading days ago, and this is probably a really good market if you trade the futures markets and you've never traded sugar in particular, or if you're kind of quasi looking at trading on the ETF side, this is a market to be looking at right now. The ETF being CANE. And I'll show you why this is the case. Where we had that sell-off yesterday, and we're working. Remember, this is a stretch low that occurred 4 trading days ago. That's what the low 4 represents. So in this case, it is orange as opposed to the pink that we have here with the stretch high that occurred back in early January, where the market sold off, and this is what we'd like to see in a perfect scenario. It's not always this clear cut, as I've shown a couple of examples, but in this particular instance, this is usually the crescendo that a lot of the other indicators that we've seen pop up, these alerts have said, hey, a lot of things are taking place, you might want to start looking at the short side. The short side, this is where you really get the quasi sell signal that we were looking for the market. So in this particular case, the market does sell off. Here is a stretch low where the market did start to rally. Well, here is a stretch low from 4 days ago. It did have the rally. It came back down. There's a bit of a base. We had a number of other indicators, a bunch of other alerts that happened that are no longer showing on the deep dive, but they have shown this crescendo effect to the bottom. We had the rally. Now a little bit of a sell-off on that one major day yesterday, and now we'd like to see if the market and this particular alert, this stretch low, is really going to start to turn into something. So this will at least give you an idea when you take a look at the deep dive, especially on the pattern side. The most important to me is always the reversal. It's one in the middle. Profit taking is instances where you want to obviously take profits. It's assumed that you're long that or short that particular market, and then when you have an instance where you have a high, you want to take profits on your long. So if you have a low, you want to take profits on your low side. When you look at the reversals, this is a major event where the market is going through a change, and you make the assumption that you're in not necessarily a trading range, although that's the best scenario, but it is the type of thing that you can have some good signals even at the tail end of trends. And then the environmental is where you actually see importance in what the trend is doing and whether or not the trend is going to continue or go into a consolidation. We'll work on that for a different deep dive, but I wanted to really point this out because we just have had so many stretch highs and lows, mostly highs, that have popped up here. And we had a number of pulses that have corresponded to the stretches that I thought important that we actually address that today in this deep dive. So we'll look at some other markets over tomorrow, probably over the course of the weekend, quite honestly. But I just want to at least give an idea as to how to use this particular information. So hopefully you find this of interest and get a feel for how to actually use the information. Do comment, do send me information as to other markets you might want to see and things that don't make sense. And obviously there's a number of things in here that I've not even addressed as of yet that you're not going to know what an EQ represents, but we'll get to them when it's important and when there's a good example that I can actually show. Otherwise, we'll be doing some type of a webinar here in, now that it's February, we'll do a full-out webinar in February where we'll go through and really explain what some of these alerts really represent. So for this time, just look at stretches as being very important, and if ever you get a pulse that goes and corresponds to it virtually in the same time, typically it will, then that's an important thing that you want to be looking at as well. And hopefully you'll find this of interest. We'll look at another market very shortly here. Thanks for watching.